Namaste, good morning. The intention is to complete section 35 and travel forward to 36, 37, 40 for the today's class. Where are we in our travel? Section 28, income, the various income. 29, mode of computation. 30, 31, 32, asset-based deductions, which consist of various aspects like building, plant, machinery, and furniture, then depreciation, where we saw normal, additional, unabsorbed, and proportionate depreciation. Apart from it, we also saw the electricity company straight line. Then 33, deposit based plantation sector is the major thing there. 35, scientific research expenditure, and 35 AD specified business. These are all the various things which we have so far seen progressing powerful in the book. In the book, Raja. In the book. Progressing forward, we are going to see when we look into yesterday's class note, we understand that there are 4 branches for section 35. We divided it into 4 branches: scientific research, specified business, social welfare, and amortization. Today we are going to, the first 2 branches we completed, the last 2 we are going to. We start with the various type of social welfare deductions. This is actually not what I would say a business expenditure, but it will be allowed. Sometimes it is business expenditure, but majority of the time, even though it is not related to your business or profession, this will be allowed. Okay, so we are going to see a set of social welfare deduction. The first is expenditure on eligible projects. This eligible projects is something which the national committee recommends. Okay, the national committee says that these projects are eligible projects, and accordingly the contribution made towards such project is allowed as deduction. In the case of company, even direct spending is allowed as deduction. Normally, contribution is allowed as deduction, but in the case of company, even direct spending. Okay, you see at many places, okay, this building is donated by India Cements. This building is donated by TVS Motors. So, okay, some eligible projects. They have a criteria, national committee, to declare a project as an eligible project, and any contribution to that project will be allowed. Also, in the case of companies, direct spending. Then it comes to rural development and eradication of poverty programs. Okay, payment to associations mainly carrying on rural development program. Okay, so any payment to that, even though it is not related to your business, it will be allowed. Any payment towards that will be allowed. Okay, notified agricultural extension projects or program. Notified agricultural extension, any expenditure, 100% of the expenditure will be allowed. Even capital expenditure will be allowed except the cost of land. Okay, not only here, everywhere in law, cost of land will not be allowed. but otherwise here 100% of the expenditure will be allowed. Okay, amongst the four, the fourth one is the important thing, that is spending for skill development. Okay, any notified skill development program, and the first point to highlight is it is available only for manufacturing companies. Yeah, amongst the four, the skill development program is going to be the important part of it. Okay, the questionable thing is skill development program. It is only for manufacturing companies. Only for manufacturing companies. If they invest in skill development program, 100% of the expenditure will be allowed as deduction. 100% of the expenditure will be allowed as deduction except land and building. Okay, except land and building. In this section, both land and building. In all other sections, okay, if we see, it is only land which is not allowed, but in this section both land and building will not be allowed as deduction. Will not be allowed as deduction. Can we make a small note? Those who have it here, can you make a small note? Note, that is, in all other sections of section, in all other provisions of section 35, that is scientific research, specified business, agricultural extension program, everything. Okay, only land will not be allowed as deduction. Only land will not be allowed as deduction. But in the case of skill development program, both land and building will not be allowed as deduction. Both land and building will not be allowed as deduction. Okay. Now going forward, okay, the next is amortization. So social welfare, in that, if you remember from your examination perspective, skill development is the questionable area. Other three, especially national committee and all, I have not seen questions. Now coming back. Now for what is amortization? Amortization means writing off an expenditure in multiple installments. Writing off an expenditure in more than 1 year. That is what is known as amortization. Okay. So the expenditure is incurred in 1 year, but the benefit is claimed over a period of time and not just in 1 year. Accountancy calls this as deferred revenue expenditure. In accountancy, the term they use for this is deferred revenue expenditure. In income tax, we call it as amortization, because in accountancy, amortization is for intangibles, depreciation is for tangibles. But here, we call amortization as writing off an expenditure over multiple periods. Okay. Totally in income tax law, as a total, we have 7 types of amortization. We have 7 types of amortization. On the basis of life, that is throughout that life period of that particular instrument, 3 are there. On 5 years, over a 5-year period, okay, remaining 4 are there. In our notebook, before starting, amortization, 2 falling branches. Okay, before starting amortization, two falling branches. On the left hand side, over the lifetime of the asset. Over the lifetime of the asset. On the right hand side, over 5-year period. Over 5-year period. On the lifetime, under that, A, telecommunication license. B, spectrum fee. C, zero coupon bonds. Repeating, over the lifetime or telecommunication license, spectrum fee, zero coupon bonds. On the right hand side, over 5 years. Over 5 years. A, preliminary expenses. B, amalgamation demerger expenses. C, VRS compensation. D, capital expenditure on promotion of family planning. Capital expenditure on promotion of family planning incurred by an Indian company. Okay. What you see in section, in the first branch, that is over a period of life, the third thing, zero coupon bonds. And in the 5-year period, the last item, capital expenditure on that. Both are in section 36. But that is also amortization. So I am clubbing it here and telling you. Okay. So if you look at it, 5 amortizations are said in section 35. 2 in section 36. For ease and convenience of study, I am combining it here. First, let us go to telecommunication license. First, let us go to telecommunication license. What is this? Okay, we all know Department of Telecommunication gives license to various people for operating telecommunication facility on payment of a particular sum of money. On payment of a particular sum of money, this license is granted. Whatever you have paid, whatever the assessee has paid can be written off over the period of license. I give you to operate for 10 years on a total payment of 10 crores. Every year write off 1 crore. Okay, over the period, lifetime of the asset. There are a couple of things which are important here to understand. Okay, one, amortization commences only at the time of payment, not at the time of allotment, etc. If you pay in installments, amortization will also be in installments. Second thing to understand is, what happens if the license is sold? These are transferable license. It can be sold as part or whole. South India part, I am selling it. Or whole of India, I am selling it. Okay, same that principles which we study as income, etc. will be applicable. Operate telecommunication facility, permission has to be obtained in the form of license on payment of a non-refundable fee. Okay, The total license fee can be written off over the period of license on payment basis. As and when the payment is made, you can write off. In case of amalgamation, okay, we saw yesterday the important terminology, the phrase transferee company will enjoy, okay, can take over and write it off over the remaining period. The provisions will apply to the transferee company as it would have applied to the transferor company had the amalgamation, had the event not taken place. In the case of amalgamation, the amalgamated company will take over its book value and write it off over the balance period. What happens if there is a sale where part of the license is sold? Sale consideration will be reduced and the balance will be written off in the remaining period. Okay, where whole of the license is sold, if the sale value is less than book value, write off the thing to P&L account. Sale value more than book value, treat it as income. Sale value more than original cost, treat that excess alone as capital gains, which is been the guideline principle all through. Read through.
So when we read business income, we had read that licenses in regard to export will be taken directly as income. Sale of such licenses. Yes.
Yes, this has nothing to do with it. There it comes under export incentives. It is a specific heading there. That license and this license are different.
Yes, sir. That only I'm saying. Thank you, sir.
Question number 23 first. Telecommunication license. Transmitters Limited acquired a license to operate telecommunication facility from the Department of Telecommunication. The license was granted on 15th June 2018 for a period of 12 years for a total sum of 12 crores. The sum is payable in 4 installments, 3 crores each year for the first 4 years. Assuming it has been paid, analyze the treatment under the following circumstances. Deduction under the said section for 4 years, for your previous year, for your previous year, which happens to be 21-22. If the company decides to sell whole of the license during the year for 6 crore 55 lakhs, whole of the license for 10 crores, part of the license for 4 crore 50 lakhs, okay, and if the company amalgamates with another company. The last question, you know the answer, but still we will go question wise and then write. Please read through. Yeah, you can claim it from the subsequent. Computation of deduction under section 35 ABB for financial year 21-22. Amount paid on 15th June 2018, 3 crores. Please understand how to work out. Amount paid on 15th June 2018, 3 crores. Less amortization for 1819. Amortization for 1819, 3 crores divided by 12 years. That is, the license is valid for 12 years. So 3 crores divided by 12 years. From here I can amortize only 25 lakhs because I have paid only 3 crores. Okay. Opening WDV as on 1st April 2019 is 2 crore 75 lakhs. Is 2 crore 75 lakhs. And amount paid on 15th June 2019, 3 crore. 3 crore. Now the license will be 5 crore 75 lakhs less amortization for 1920, 5.75 crores divided by 11 years. Now the license is only valid for 11 years. Now the license is only valid for 11 years. 52 lakh 27,273. WDV as on 1st April 2020. And amount paid on 15th June 2020, 3 crores. Less amortization for 2021, 8.22 crores divided by 10 years. Now the license is only for 10 years. WDV as on 1st April 2021 is this money. This is our WDV and amount paid on 15th June 2021, the last installment of 3 crores. Less amortization for 21-22, our okay is approximately 10.40 crores divided by 9 years. Okay, this divided by 9. So this is our answer. That is, this year I can claim 1 crore 15 lakh 60,606. On payment basis, whenever payment is made, amortization begins. Okay, over the balance period, you will keep on amortizing. Am I clear to you? Okay, right? Case B, if the company sells the whole of license for 6 crore 55 lakhs, if the company sells whole of the license for 6 crore 55 lakhs, I start the question here. Okay, 1 minute. Where license is sold for 6 crore 50 lakhs. We all know WDV is, as on 1/4/2001, 7 crore 40 lakh 45,455, and I paid 3 crores. Now, less sale value of license is 6 crore 50 lakhs. Huh? 6 crore 55, sorry. Okay. So, amount to be written off to profit and loss account, amount to be written off to profit and loss account, this minus this. Okay. 3 crore 85 lakh 45,455. Okay. Uh, I request you to make this as 11 lakhs instead of 10 lakhs. I request you to make it because my intention is to tell you how the income comes. So kindly make this as 11 lakhs instead of 10 lakhs. Instead of 10 lakhs, 11 crores, sorry, 11 crores. Okay. Instead of 10 crores, make it as 11 crores. So that my intention is how to compute the income part of it. 59 lakh 54,545 will be treated as income in the third case. Where part of the license is sold for 4 crore 50 lakhs. Where part of the license is sold for 4 crore 50 lakhs. Sale value of part of the license is 4 crore 50 lakhs. Okay. Amount available for amortization. Amount available for amortization. Where part of the license is sold, the balance has to be written off over the remaining period. How much is the remaining period? 9 years is the remaining period. Okay, 9 years is the remaining period. We know 12 years it is allotted. First 3 years is over. Okay, part of it is okay, it should be amortized over the remaining period. Less amortization for financial year 21-22. Okay, this divided by 9. Okay, 5.90 crores divided by 9 years. Okay, okay, so closing WDV as on 31st March 22 will be No, the question asked is, will the sale date have an impact? The purchase date and the sale date are irrelevant. Only the year is relevant. For example, 15th June only I am paying. Should I amortize for 8.5 months or 7.5 months? No, that year. And similarly, sale date does not have a value. No, it
Sir,
is not 180 days contract.
sir, one doubt.
Go ahead, Ananya.
Sir, when we are selling, when we are selling the asset for totally for 6.55 crores or 11 crores in the two previous cases, um, there is a balance.
Yes, the balance, since the whole of the license is sold, the balance will either be treated as expenditure or income.
So that expenditure cannot be claimed as deduction.
It can be claimed. That's what income tax. This section 35 is what it is coming under, expenses that can be claimed as deduction.
So the 3 crores 85 lakhs that we wrote that can be written off to P&L can be claimed as deduction also.
Yes.
Okay.
No more addition. In case of amalgamation, provisions will apply to transferee company as it would have applied to transferor company had the event, that is amalgamation, not taken place. Okay, provisions will apply to the transferee company as it would have applied to the transferor company had there not been an amalgamation. In other words, okay, that is the, it amalgamates with transformers. Transformers Limited can start claiming the amortization over the balance 9 years. Okay, it goes back to case A where Transformers Limited can start claiming for balance 9 years. So, telecommunication license, the license piece to be written off, and that is where here comes the payment basis, which gets importance. Only on the basis of payment we are starting to write off. 35 ABA spectrum fees, same, no change, only the name changes. Otherwise, the provision is the same on the basis of payment over the period, sale at the time of sale, all things remains constant. That is the 2G, 3G. License fees is original, 2G, 3G is spectrum fees. The next one is amortization of preliminary expenses. Amortization of what is popularly known as preliminary expenses. That is, what is preliminary expenses? First, let me break some of the myths that are popularly understood, but it is not right. Preliminary expenses is not just for companies. It can be even incurred by a sole proprietor, by a firm, by a LLP, any entity. Second myth is preliminary expenses is incurred during the first year. No, it can be incurred at the first, definitely at the before commencement of business, and every time when there is an expansion of business. I'm presently in a particular type of activity. I expand to a new level of activity. I make some expenditure for that. That is also known as preliminary expenses. Preliminary expenses does not mean that it is incurred one time only. It is a continuing multiple level activity. The provisions are available for Indian companies and resident non-corporate assessees. So it is not only for companies, it is also for other preliminary expenses may be incurred while setting up of an undertaking, or there is an extension of an undertaking. So not only with the time of beginning, it can also be a running concern which expands its activity. For that, whatever they incur is also known as preliminary expenses. For example, what happened for what became the greatest news of recent time, Freshworks. What they did is also a sort of preliminary expenses only. Okay. The term preliminary expenses include income tax law says what are all the things which will be included in preliminary expenses. Income tax law says the following are preliminary expenses: preparation of feasibility report, project report, market survey, engineering services related to the business, provided the work is carried on by an approved agency. Okay, not by everybody, it should be by an approved. So whatever you do before your commencement, okay, the feasibility study, project report, market survey, etc., and then whatever legal charges you incurred for prospectus, memorandum, articles, expert fees, everything, okay, till share issue. What is share issue? Share issue commences with prospectus and ends with refund of application money, excess application money. So all these things, legal charges for drafting any agreement, any collaboration agreement, etc., legal charges for drafting MOA, AOA, registration fees, issue expenses, which is right from issue of shares to refund of application money. Okay, so please understand the law has defined what is preliminary expenses. If whatever other than this, you cannot claim. Okay, preliminary expenses. So law has defined what is preliminary expenses. Actual preliminary expenses, okay, we all know we will get some amount, okay, And then the law says there is a cap, there is a maximum restriction. Okay, right? Total PE, that is actual preliminary expenses, cannot exceed 5% of cost of project or capital employed. Okay, so the law says there is a restriction. You cannot have a exorbitant preliminary expenses. It cannot exceed cost of 5% of cost of project or 5% of capital employed. What is cost of project? It is nothing but the asset side. Okay, it is nothing but the fixed asset, investment, etc. What is capital employed? We all know it is nothing but the liability side. That is share capital plus reserves plus all long-term borrowings. Okay, whatever you do in your financial management or in our accounting, okay, capital employed is nothing but, okay, share capital plus a reserves and surplus plus all long-term borrowings. Okay, so what I will do is I will take both these things. Okay, we will compute 5% of whichever is higher amongst COP, cost of project, or cost of capital employed. Okay, I will compute 5% of either cost of project or cost of capital employed. Okay, and then the qualifying amount will be, okay, actual PE or 5% of either one of them, okay, whichever is less. Whichever is less. I am repeating. As a step, if you look at it, I will, as step 1, compute the actual preliminary expenses. Step 2, I will consider either cost of project or capital employed. Whichever is higher, of that I will take 5%. Again repeating, step 2, cost of project or cost of capital employed, whichever is higher, on that I will take 5%. Qualifying amount will be either of these two, whichever is less, and this qualifying amount will be amortized over 5 years. This qualifying amount will be amortized over 5 years. Now, there is one other question the law answers. Okay, suppose today, okay, 19th October, okay, the company gets commencement of business. Okay, 19th October, the company gets commencement of business certificate. Now I need the capital employed and the cost of project. Should I consider the cost of project and capital employed as on 31st March 21, the last balance sheet date, or the subsequent balance sheet date, 31st March 22? Law has answered it saying last day of the year in which the business commences. Law 31st March 22. How law says? Last day of the year in which the business has commenced. Business has commenced on 19th October 21. So I will take 31st March 22. Okay, repeating. So these are all the preliminary expenses. Okay, the maximum amount of preliminary expenses should not exceed 5% of cost of project or capital employed. In the case of other than companies, 5% of project. Okay, project is nothing but fixed assets. Asset side, capital employed. Deduction will be 1/5, and you can see audit is mandatory. Okay, even for preliminary, all under 35, audit becomes mandatory. Okay, transferor will have the same provisions, etc. Okay, read through please. Here, last day of the previous year in which the business commences. You want this, sir? Read through once.
Third, in certain cases, when companies perform big projects every year, they may have four projects which are very big in the same year. So for each project, is this permitted?
No, no. Is the company doing the same projects for different turnkey projects? No problem. The company is in infrastructure business. They can have multiple projects. That is not known as preliminary expenses, every project. The company is in infrastructure business. They also start airways. They also start road transport. At that time, you are expanding your business. That is what is known as preliminary.
Yes, sir.
Deduction is 1/5 of the qualifying amount for 5 continuous years. I'm looking into the question number 22. Apple Limited is incorporated on 10th October 20, but commences business from 16th November 21. But commences business from 16th November 21. So we can compute from 21-22 only, from the year of commencement, and we will take the capital employed or cost of project as on 31st March 22. 31st March 22. During the period of prior to commencement, the following expenses were incurred: registration fees, drafting of MOA, AOA, legal fees, underwriting commission, expenditure on refund of application money, preparation of feasibility report, project report, market survey. Market survey alone, work undertaken by a concern which is not approved, foreign collaboration agreement, engineering services for plant and machinery, that and all will be part of cost of asset. Determine the amount of deduction under 35 AD after considering the following: cost of fixed asset, share capital, debentures, and long-term borrowings. Read through. Step 1, actual preliminary expenses. Step 1, actual preliminary expenses. Registration fees 20,000. Drafting, printing of MOA, OA.
So foreign collaboration agreement charges.
I missed it. Yeah, foreign collaboration 45,000. Cost of project as on 31st of March 2022. Okay, commencement is in November 21. So I will take last day of the year. Okay, 96,01850. 96,01850. Cost of project 96 lakh 1,850.
Sir,
Capital. சொல்லுங்க.
sir, engineering services related to the business of assessee, is that not what is, it says engineering costs of erecting plant
Plant and
machinery.
machinery. So அது இங்க வந்துரும். Plant and machinery யோட include ஆயிருக்கும். அது it is
Okay,
not
okay,
for commencement of business. It's for plant and machinery.
okay, sir.
capital employed, okay, capital employed will be share capital plus debentures plus long-term borrowings. Okay, 57 lakhs plus 11 lakhs plus 24 lakhs. Okay, 11 lakhs plus 24 lakhs. Okay, so 57 lakhs plus 11 lakhs plus 24 lakhs. Okay, 92 lakhs. Whichever is higher, so I will take a maximum of these two things, whichever is higher. So 5% of cost of project, 5% of cost of project will be, okay, 4,80,092. 4,80,092 or 93. Am I clear to you? Okay. This is 5% of whichever is higher amongst those two. Step 3. Qualifying amount. Okay. It is step 1 or step 2, whichever is less. So 4,80,093. Either 5,92,000 or 4,80,093, whichever is less. Okay. Step 4, deduction 1/5 of qualifying amount. 1/5 of qualifying amount for 5 years I can claim. Okay. Each year for first 5 years from the data from the year of commencement. Are we clear? Again, rarest of the rarest question. Okay, just to keep you, they will give you the preliminary expenses amount and you have to amortize 1/5. Okay, rarely they don't have the space to ask these questions now with 70 marks only. They don't have the space, so okay, just for your understanding. Okay, in preliminary expenses, there is a case law whether securities premium will form part of capital employed. The answer given by the Supreme Court in Berger Paints is no. I believe that the form that they file in ROC does not have security. They have long-term borrowing, other things. Securities premium will not form part of, okay, capital employed. Will not be if the intention of the list so, then it would have been mentioned. Okay, they have mentioned long-term borrowing, they have mentioned reserves, they have mentioned, but they have not included securities premium. So probably, I don't know why, but popular amalgamation demerger expenses will be claimed in 5 equal installments. Amalgamation demerger expenses, okay, will be claimed in 5 equal installments. Similarly, VRS compensation, we all know that the number of employees who take up will be very high. Okay, writing it off in 1 year will be a big loss for the entity. So in 5 equal installments, it will be written off in 5 equal installments. Okay, minerals, don't worry. Okay, mineral, wherever I have seen, I have not seen a question. Okay, as I told you, section 36 also has some amortization, which I am speaking here. Discount on zero coupon bonds. We all know this is also known as deep discount bonds. Okay, the difference between issue price and redemption price is known as the discount. The difference between issue price and redemption price is known as discount. That can be written off over the period of bond. Let us take my issue price is 60 rupees. I am redeeming it at 100 rupees. Okay, and I issued 1 crore bonds, which means 40 crores. I cannot write it off in year 1 or year 10. Over 10 years, this 40 crores has to be that discount. The difference between issue price and redemption price, that discount has to be written off over the period of bond. And deduction for family planning expenses incurred for employees. Indian companies only can claim it. Remember, it is not available for a firm, sole proprietor or other things, foreign company. It is only for Indian companies. Revenue expenses fully allowed. Capital expenses will be amortized over 5 equal installments. Capital expenditure will be amortized over 5 equal installments. Okay, leaving off the minerals, if you look at it, there are 7 amortizations. Okay, 7 amortization, 4 over 5 years. Okay, and 3 over the lifetime. Over the lifetime or telecommunication license, spectrum fees, and zero coupon bonds. Over 5 years or preliminary expenses, amalgamation demerger expenses, VRS compensation, and capital expenditure. Revenue is immediately. Capital expenditure on promotion of family planning incurred by an Indian company only, not anybody. Please read through the section once. Please read through the unit once. That 20 rupees discount in your example is written off over the bond period. Per bond, 20 rupees. How many bonds? Whatever. Yeah, interest, or that is known as interest. For the investor, it is interest. For the company, it is discount. Zero coupon, 0.8 of interest, but actually it is the interest. Am I clear to you? Right? Okay. Moving on, my dear friends. So where are we? We traveled up to section 35. All the 4 branches of section 35 is over. Okay. 35 is basically speaking about capital expenditure claimed as deduction except the cost of land everywhere. Okay. So it's again a long travel, scientific research, specified business, amortization, social welfare deduction are the 4 things which we saw in section 35. Next is section 36. The next one is section 36. What is section 36? Section 36 speaks about other deductions. Section 36 speaks about other deductions. There is a list of items which are specified in section 36 which can be claimed by the assessee. Okay, it starts with insurance premium. Okay, it starts with insurance premium for stock including livestock, insurance premium for stock including livestock, and also insurance premium for employees. Group insurance premium for employees are allowed as deduction. Repeating, insurance premium for stock including livestock, group insurance premium are allowed as deduction. Am I clear to you? Okay. So insurance on asset not allowed. Capital expenditure year to year pay பண்ற insurance. Is insurance on asset not allowed? It is not specified.
Sir, it is specified in 3031.
That's beautiful. It is specified in 3031. 3031 are specific section for asset. Why I always say that it should be clubbed in 36 is இங்கே கொண்டு போட்டுடலாம். You don't need that section. Actually, effectively, 4 sections, if you keep, it's enough. Okay, as our friend Hari has said, it is already spoken in 30. We saw 30 asset-based deduction for building what you can claim. There you saw insurance for machinery, plant, furniture. There you saw it is not specified here, it is specified there. So otherwise, all insurance are covered here. Then bonus or commission payable to employees subject to provisions of section 43B. Subject to the provisions of section 43B. We will see 43B later. On a bird's eye view, it should be paid 1 month prior to the due date of filing returns so that it can be claimed as deduction. Okay, 43B. Interest on borrowed capital. Okay, here I want to take your time. Okay, assessee should have borrowed money. Okay, which means it is not interest on capital is not considered here, only interest on loan, and such borrowed money should be used for the purpose of business or profession. Such borrowed money should be used for the purpose of business or profession of the assessee. Then it will be allowed. Okay. In various cases, okay, I cannot give you a ground rule now, but holding company gets loan, and they in turn give loan to subsidiary company. There are contradictory judgments. This is not your main business. The money that you have borrowed is not used for the purpose of your business or profession. The money that you have borrowed is not used for the purpose of your business or profession. You have transferred that money. There is an immediate entry by which you are transferring that money to your subsidiary company. So deduction will not be allowed. Is one school of thought. A set of case laws. Another set of case laws says, no, it is allowed because you have invested in that company. Whatever is the result of that company directly affects your performance also. So it should be allowed. I cannot give you recent case law. Okay. I cannot give you one ground rule for that. Okay. Depending upon the question, we can write yes or no. Okay. Depending upon the question, we will see what the question is, okay, and then we can write the interpretation. In the recent cases, though it is not there in our examination questions, case laws, but in a recent case, I got loan and I paid advance to creditors. I got loan, and whatever loan I got, I paid it as advance to creditors. Can I claim the interest? Yes, I can claim. Yes, I can claim. Okay, it is used for my business or profession. Sir, you have advanced money to creditors without interest, but you are paying interest. Can you claim? The answer is yes, you can claim. Advance payment to creditors is in the natural course of business, is in the normal process of business, so that can also be claimed. Okay, so whatever interest on loan is allowed. Employers' contribution to RPF, superannuation fund, gratuity fund, that is LIC, a gratuity fund, all those things are allowed. Okay, subject to 43B. Employers' contribution to pension scheme is restricted to 10% of salary. Employer contribution to pension scheme is restricted to 10% of salary, salary being basic pay plus DA. Okay, PF there is no limitation, whereas for pension fund, employer can contribute only 10%. Okay, gratuity fund again, as I told you. And this is what we saw in the first class also as an amendment, clarificatory amendment, but most important, employees' contribution to pension for provident fund, ESI, etc. It should be made within the due date of the respective law. It should be made within the due date of the respective law. Otherwise, it will be taken as income. Deduction is allowed if the contribution is made before the due date of the respective law. Okay, and Finance Act 21 has said that if it is not made, it will be treated as income. It will be treated as income. Can bad debts be allowed? The answer is yes. No doubt bad debts can be allowed, provided it is recorded as income earlier. Bad debts will be allowed, provided it is recorded as income earlier. Okay, it is considered as income, okay, in the earlier years. Okay, and the most important condition is bad debt should also be written off in the books of accounts. You cannot just claim it in the income tax adjustment statement alone. It should be written off in the books of account. Okay, in that case, it will be allowed. It will be allowed even to the successor of business. It will be allowed even to the successor of business. Okay, okay. Provision for bad and doubtful debts. Provision for bad and doubtful debts. Normally, this is not allowed. This is a contingent provision. Normally, this is not allowed, but it is allowed in the case of banking and financial institution. It is considered, it normally for a manufacturing company, trading company, service sector, nowhere provision will be allowed. Actual bad debts allowed. Provision is always a contingent. 3% of debtors will not be collected. That is not at all possible. So it is a contingent liability, so it will not be allowed. However, it will be allowed in the case of banking and financial institutions. In the case of banking, provision will be 8.5% of total income plus 10% of rural advance. In the case of financial institutions, including NBFC, 5% of total income. Accountancy gives us one concept. If there is a provision and as well as bad debts should be taken to provision. You cannot claim both. Okay, that is also applicable for banks. That is also the accounting concept of adjusting the actual bad debts against the provision should be adhered under income tax law as well. Okay, Don't worry about 3618. Okay. The others are contribution, securities premium, commodity transaction tax, and mark to market losses. Other two we have already studied in section 35, that is the amortization. Please read section 36. It's very simple, straightforward. Please read section 36. Once, please read section 36. Yeah. Mediclaim, LIC, both. Yeah, life and health. Group insurance.
Sir, in provision for bad debts being allowed as a deduction, they
Yeah,
have
go
given
ahead.
provision shall be 8.5% of total income. So the so the act mentions the amount that can be taken as a deduction directly, and they are not saying how much of the provision can be taken as deduction, right, sir?
8.5% of total income can be taken as deduction.
Yes, sir. Okay.
I'm in question number 23. I'm in question number 23. The following are the particulars in respect of a scheduled bank incorporated in India, domestic bank. Provision for bad debts, gross total income before deducting provision, aggregate advance for rural branches, bad debts written off in the books of accounts during the previous year. Compute the deduction available for provision and bad debts for your respective assessment year. Gross total income, I'm doing it in absolute value, 800 lakhs. rural advance 300 lakhs. Provision allowable, okay, 8.5% of total income. So 8 crores into 8.5%, 10% of rural advance. 3 crores into 10%. Total provision that can be claimed. Total provision that can be claimed is 98 lakhs. என்னது or and opening balance of provision for bad debts, they have said, okay, provision for bad debts 100 lakhs. Total amount in provision at the closing, total amount at the closing is 1 crore 98 lakhs. 1 crore in the beginning, 98 lakhs created during the year. 1 crore 98 lakhs. Bad debts, actual bad debts for the year, actual bad debts for the year 2 crore 10 lakhs. 2 crore 10 lakhs less adjustment with provision, adjustment with provision 1 crore 98 lakhs. Net bad debts to be claimed for the year 12 lakhs. So current year you can claim 98 lakhs as provision, 12 lakhs as bad debts. Current year you can claim 98 lakhs as provision, 12 lakhs. 210 lakhs is the total bad debts. 100 is the opening balance of provision adjusted. Remaining 110 you have to claim it in two different ways. One as provision, one as actual bad debt.
Sir, one doubt.
Yeah.
Sir, this urban advances, whatever, that 5% is not eligible actually.
Ida, rural advance.
No, sir. Urban advance.
No, sir. There is nothing called urban advance. It is 10% of total income plus 8.5% of total income plus 10% of rural advance. For others, 5% of total income.
Okay, sir.
I'll also check once, but I'm little confident. Question number 24. X Limited contributes 20% of basic pay to the account of each employee under a pension scheme referred to in section 80 CCD. depreciation allowance, dearness allowance is 40% of basic pay and it forms part. Compute the amount of deduction for the pension if the basic salary is 10 lakhs. Would the disallowance under 40A9 be attracted? If so, to what extent? Yes, the same we will do that. First read through. The same provision 40A9 also. Actual contribution 20% of basic pay. Basic pay is 10 lakhs into 20%. Less actual contribution 2 lakhs less, okay, maximum allowed. Basic pay is 10 lakhs. BA forming part is 40% of basic pay. So this into 40%. Okay, I'm getting 14 lakhs. Okay, yeah. 10% of salary. So this into 10%. Okay. Therefore, contribution to be disallowed. Therefore, contribution to be disallowed is 60,000. Therefore, contribution to be disallowed 60,000. Am I clear? Contribution to be disallowed is 60,000. I'm going into the last provision, but this is where the major expenses are claimed. Nowhere else we are claiming salary. We haven't studied in section 30 to 36 that. We are going to see it in section 37. All, if you take your debit side of your P&L account, trading P&L, purchases, printing and stationery, traveling, that 80% of the item are going to be covered in section 37. Okay, this is the major section, but it does not have any list. We call it as general deduction. We call it as general deduction, and we say some conditionalities. If those conditionalities are fulfilled, then the expenditure will be allowed as deduction. If those conditionalities are fulfilled, expenditure will be allowed as deduction. It should not be an expenditure which is spoken in section 30 to 36. Then you claim it there. Why do you want 37? It should not be capital. It should not be personal. Incurred during the previous year. Incurred for the purpose of business or profession of the assessee. Allowed. Repeating. It should not be an expenditure which is already mentioned in section 30 to 36. It should not be capital. It should not be personal. It should be incurred during the previous year and incurred for the purpose of business or profession of the assessee. Then it is allowed. Otherwise not allowed. If any of these condition is not fulfilled, it is not allowed. Okay. Expenditure should be incurred in the previous year. This is where we understand prior period items are not allowed under income tax law. This is the place where we understand that prior period expenditures are not allowed under income tax law. It will not be allowed. So, expenditure should be incurred during the previous year and it should be incurred for the purpose of business or profession. There are circulars, case laws, and some discussions which we will have. The first discussion is on penalties. Is penalty allowed? No. Penalty means violation of law. What law prohibits? If you do, you are paying penalty. Such a penalty is not allowed as a deduction. What law gives you? Okay, penalty is for violation of law. Okay, it is not deductible. Okay, right? But remember, later I have written later. Interest is allowed. Only penalty is not allowed. Interest in late filing of GST returns. Interest in delay in payment of PF is allowed. Whereas penalty is only not allowed. Interest is, in our easy understandable term, intra-virus law. Penalty is ultra-virus law. Interest is delay in procedural compliance. Okay. But 234B allowed. 234A, B, C. Interest for late filing of income tax return allowed. No, not allowed. Because income tax itself is not allowed. Okay. When income tax is not allowed, interest on income tax is not allowed. Whereas interest on the other, why this I am taking is, in many questions they used to test you. Interest on delayed payment of GST. You will allow it. Interest in delayed filing under income tax law. You will not allow that. That expenditure you will add back. Because income tax itself, 40 we are going to study. Income tax, any payment under this act is not allowed. So that is why. Am I clear to you? Okay. So penalties are not allowed, whereas interest is allowed. Later I have written that. CSR expenditure not allowed. The Companies Act makes it mandatory. Okay, spend it, but it is not for the purpose of your business or profession. So it is not allowed. But sometimes it fulfills both criteria. Or research expenditure, contribution to IIT for research. It is coming under section 35 also. It is coming as a CSR expenditure also. Allow it. Contribution to Prime Minister's National Relief Fund. It is a CSR expenditure. 80G can also be claimed. Claim it. contribution to a project eligible under national committee. It comes under CSR as well as section 35CCC allow it. Okay, so CSR expenditure normally not allowed. However, the finance minister has clarified that CSR expenditure which is in the nature of 30 to 35 will be allowed on the basis of conditions specified in the respective sections. Mostly 35 only. Though 30 to 35, 35 only. Okay, but generally if they give you CSR expenditure, it is not allowed. Okay, shall not be deductible under section 37. Advertisement in the souvenir of a political party. Advertisement in the souvenir of a political party, okay, shall not be allowed. In the publication souvenir of the political party, that will not be allowed. But one benefit you can get is that advertisement can be treated as a donation to political party. That advertisement can be treated as a donation to political party. Claim 80 GGB if it is a company, 80 GGC if it is anything else, anybody else. First, let us understand some circulars and then go for case laws. Okay. Is printing a manufacturing process? Printing and publication of books. Yes is the answer. Long pending. Now it is clarified that manufacture means there should be a change. A raw material, manuscript, is converted into a final product which is known as a book, which has a separate marketability. So printing and publishing will take the character of manufacture. Now additional depreciation can be claimed, ETI deductions can be claimed. In section 28, I told you Keyman insurance policy. I'll speak somewhere else. Let me take this opportunity. What is Keyman insurance policy? Please understand, key people of the organization are insured by the organization. Key people, CFO, COO, CEO are all insured by the organization, and the organization pays premium allowed as deduction. Keyman insurance premium is allowed as deduction. Okay, all of us, insurance paid on Keyman insurance policy is allowed as deduction. When the policy matures, it is an income. When the policy matures, it is an income. I have assigned the policy. The payer is the company, but I have given the policy to the CEO, CFO, COO. Assigned the policy to the respective employees. For the employee, it is taxable either as perquisite or IFOS. If you are still continuing as an employee, perquisite. If you have quit as an employee when you are receiving the maturity value, IFOS. Whatever it is, premium paid is an expenditure. Amount received from the company is an income. Company da premium paper. Policy is only assigned, not the premium. Premium is paid by the company. This is a very interesting aspect, which this circular is being challenged by the Pharmaceutical Association, and they lost the case also. Okay, but practically I can see, if you have visited a doctor, okay, if you have visited a hospital or a doctor, and if you have gone inside his cabin, except him, everything is sponsored. Cricket players and doctors, okay, only their body is sponsored by God. Okay, other things are all, everything is a sponsor. In the doctor's table, if you see a pen stand, co-stand, table weight, table, chair, coat he wears, stethoscope he uses, the tablet prescribes. Pharmaceutical companies say this is our normal business, boss. How else? This is the way we convince the doctors. Indian Medical Council ethics. CA Institute ethics ஒன்று இருக்கு. ஆடிட்டிங் பேப்பர்ல ஒரு 10 மார்க்ஸ் வரும். ஓகே, அது தவிர அதுல படிக்காதீங்க. ஓகே, so the Indian Medical Council ethics says the medical practitioner, that is doctor, is not supposed to receive it. And the companies are not supposed to give it. Any freebies. Freebie matralla, samples. They are not supposed to receive and the company is not supposed to pay. This circular says for the paying company, pharmaceutical or whoever it is, it will be disallowed. Such an expenditure will be disallowed because you are violated an ethical practice. And for the receiving doctor, the fair market value will be treated as income. CBDT has clarified that freebies provided by pharmaceutical and health sector entities to medical practitioners is against the provision of Indian Medical Council regulations, and hence the same is not allowed as an expenditure. The circular further provides that the fair market value of such freebies will be treated as income either under PGBB or IFOS for the medical practitioner. In the circular challenge பண்ணாங்க. Confederation of Indian Pharmaceutical Association challenged this circular saying, boss, this is our regular business. It is as if you are saying don't do business. Okay, so they challenged this circular. The Confederation challenged the CBDT circular which allows freebies to. High Court held any expenditure which is prohibited by law is deemed to have not been incurred for the purpose of business or profession. The circular is in line with the principle, hence it is not allowed as deduction. Now it is High Court ruling also that it is not allowed. Okay, traveling expenses of doctors, pharmaceutical companies are incurring it. Personal travel expenses, all these things are not allowed. Next case is stunning. I paid a commission to doctor for referring patient. Anna TDS la pidichen. Nermiyana. Okay. He's a very good man. If you give him money, he'll finish the work. Okay, like that. Okay. So I paid a commission to the doctor. And said that, sir, otherwise how will I get, this is a sales promotion expenses. Court said this is against ethical practice. Demanding as well as paying commission is bad in law. It is not a fair practice. That's okay. So related to the doctor, so I related both these things. But that circular is now holding good. Freebies you cannot provide. That is happening. They deduct TDS and pay. That is not allowed. Okay, that is what I can say. Okay, so still how they are claiming it? The office room la vandu kelunga. Okay, okay. So, next about films. Do you know when a film can claim the deduction? A film production? when the censor certificate is obtained. Please remember, when censor certificate is obtained only, till that time the cost of production of film should be capitalized. Till such time. Okay? Imagine a film like Bahubali or Shankar's films, which take multiple years. They are to capitalize the whole cost in the year in which censor certificate is obtained, you can claim the deduction. What happened halfway through? I abandoned the film. There were no mention about it because the law said only if you get censor certificate you can claim. If the film is abandoned, censor certificate cannot be obtained. So assessing officer said you cannot claim it. So came this circular which gave the benefit. Cost of production. Rule 9A provides that for deduction of cost of production of future film which are censor certified in the previous year in which the said certificate is obtained, the said rule is not applicable for. The circular clarifies that the cost of production of abandoned films can be claimed as revenue expenditure in the year in which they decide to abandon. Adukapra, you cannot incur any expenditure on that. Yeah. Okay. You should abandon, you can claim it as deduction. BOT projects, which we are all very clear now. Build, operate, transfer. Okay, simple. You need not read the circular to understand it. Sir, I am Larsen and Toubro. I am DCF. I am a company who lays all the highways. What the government tells me, I will give you land. You lay the road, build. You operate it. Collect the toll for 10 years, 15 years. At the end of the term, transfer it. Build, operate, transfer. So the road I am laying is a capital expenditure, but I am not going to own it. There is no ownership. Adukana depreciation claim because I am going to give it back to the government. The road I am laying is a capital expenditure, built. I can operate, but at the end of it, I cannot. Okay. So I have incurred an expenditure of, let us take 70 crores on laying of this road. And 10 years I can operate it. Law just says 70 crores divided by 10. Every year 7 crores you claim. Toll fees is your income against which you can set off this. Okay. In such project, assessee does not hold any ownership rights, hence depreciation cannot be claimed on the expenditure. Cost is recovered as toll charges over the period. Hence, the cost incurred for construction is recovered over the years and not just in 1 year. Okay. So this is a continuing amortization. This is a continuing basis. The circular clarifies that the cost incurred shall be evenly amortized. Okay. Because initially the traffic might be less as the days goes by the traffic, but that doesn't mean it is evenly amortized. Where any deduction has been claimed already, reduce that cost, remaining you may amortize. Okay, any expenditure already claimed, reduce that cost and then amortize that. Am I clear to you? These are all the circulars that are there for this year. Okay, that is printing, human insurance policy, freebies, which is being challenged, and cost of abandoned films, and treatment of expenditure in the case of build, operate, and okay. So those are all the circulars which are important. Now the case laws. What does the case law should tell? Majorly case laws are covering whether it is a capital expenditure or not. Majorly case laws covers whether it is a capital expenditure or not. and how to treat that particular item. The first famous case law is this glow sign boards. Okay, you can see big ceramic glow sign boards that are being posted everywhere. Whether it is a capital expenditure or revenue expenditure, court have said the life of that is an uncertain thing. It can go off in weather conditions. Even a small stone can put the entire structure down. So it can be treated as a revenue expenditure. Oriental Ceramics case held that those sign boards are revenue expenditure. Okay, glow sign boards are revenue expenditure. Then the next capital versus revenue happened that I incurred expenditure on a research project. Understand? Okay. I incurred expenditure on a research project, feasibility study, and the project got dropped, shelved. The project was shelved, got dropped. How to treat this expenditure? Income tax law, the court said, asset is not created. If the asset is created, then it can be capitalized with the cost of the asset. When no asset is created, it should be treated as a revenue expenditure. Okay, this is a famous case law of Priya Village Roadshow, PVR theaters. Okay, Ada full form. Priya Village Roadshow. They are roadshow people. Today they have become a multi-billionaires. They are roadshow people. Okay, they had a feasibility study to increase the sound system of their theater. They did a feasibility study for increasing the sound system or the sound experience, but that new system did not work. So they shelved the project. Okay, they shelved the project. Okay, Assessee incurred feasibility study for technological advancement of its existing business. It's not for a new business. It is for the existing business. If it is new business, then it would not have been allowed. Okay. However, the project was abandoned and the expenditure. Yes, since the feasibility study were conducted for an existing business, okay, no new asset not getting generated, okay, new asset not getting created, the project was abandoned, the expenditure can be claimed as revenue. The expenditure can be claimed as revenue. Okay, right? Okay, so these two are capital versus revenue. Okay, expenditure. ITC Hotel expenditure on issue of shares. We all know it is either not allowed or allowed as a preliminary expenditure. Law specifically states that expenditure on issue of debentures, convertible debentures. Assessing officer said it should be amortized over the period of debentures. It cannot be claimed as deduction. Court said, where is such a provision? If the lawmakers intended amortization, they would have given it as part of amortization. In the absence of any specific provision, it can be allowed in the year in which it is incurred. Expenditure on issue and collection of convertible, it shall be treated as a revenue expenditure. Be it convertible or not, expenses on issue is a revenue expenditure because there is no specific provision for treating it as capital. I'm not even looking at Shanti Bhushan case. Okay, I don't know why Institute still maintains that case. You know that famous lawyer, Prashant Bhushan's father, Shanti Bhushan. He claimed his heart surgery as an expenditure, professional expenditure, stating heart is plant and machinery. My heart is a plant and machinery for my profession, so it is a heart surgery is a repair. Court, they asked, is your heart only beating when you are carrying on profession? Okay. What cost you acquired? What is the block value? Uh, what is the proportionate application of business and non-business? The case law, basically stupid the case law. Institute is maintaining it as recent case law is unacceptable. It's unacceptable by any standard. So, a theater paid to police personnel and gundas don't cause any disturbance to our theater. Even now you can see hotels pay police personnel outside to ensure that the customer or mother, you please don't irritate him by not asking him to park here, park there, not to cause any disturbance, etc. And say, unless I do it, I cannot run my business. But the court said, just because it is essential, it doesn't mean it is legal. Illegal payments, bribery is not allowed. Bribery is not allowed. Management expense, sorry. Okay. Normal security expenses are allowed. However, in this case, the payment is illegal and against public practice. So it is not allowed. It takes the character of bribery. That's what they said. Okay. A company constructed 5th floor without authorization. Only 4 floors are allowed. 5th floor I constructed for which I don't have authorization. The MMDA authorities, CMDA authorities saw it and said, you are violated, so pay regularization fee. So that the construction becomes regularized. And I paid regularization fees and claimed it as deduction. Yeah, not allowed. It is not, it is a penalty. Name, character only changes. Yeah, it is a penalty, but only the character, the name is getting changed. Okay, the description of compounding fees or regularization fees in case for violation of law, which is nothing but penalty, hence it will not be allowed. This takes the character of penalty. Name cannot be the determining factor. Breach of law was there. And the last case, which is not a recent case, but I want you to know because many questions in the future we are going to work out. Infosys, they erected traffic signal outside their office. Okay. You are all very much aware of it. If you go to Bangalore, okay, what's the traffic? 1 kilometer takes half an hour to 45 minutes solid. Okay, if you walk, you are faster. Okay, so for safe crossing of their employees, they erected a traffic signal. They cannot operate it. They have to give it to the state government. They erected the traffic signal, gave it to the police department there. So asset is not owned by me, but expenditure is incurred by me. For claiming depreciation, asset should be owned by the assessee, used for the purpose of my business or profession. So I said, this is my staff welfare expenditure. Otherwise, it's risky for my staff. Department agreed, court agreed. Yes, the expenditure indirectly helped the staff and the business. the asset is not owned by the assessee, hence the expenditure is allowed. Okay, this will be repeated in some questions very often, that's why. National cooperative development, the source of fund from, if it is a capital income, it is a capital expenditure, not necessary. Share capital I received and spent on salaries. Financial management, the income tax law. The source of fund from which expenditure is made is irrelevant. Every application of income towards business objective is a business expenditure. There can be a receipt which is treated as capital, but the spending of the same can also be maybe a revenue expenditure. Okay, so these are all the section 37 case laws which you should know. Okay, I have not marked it, and we quickly mark this. Oriental Ceramics and PVR are capital versus revenue. Oriental Ceramics and PVR. If you can take your notebook, friends who are on online, write it. Capital versus revenue, under that Oriental Ceramics and Priya Village Roadshow. Okay. Penalty and violations are the other two. That is Neelavati and Millennia developers. Neelavati, both are illegal expenses only. Neelavati and Millennia developers. Violation of law. Asset not getting created, or I'm sorry, capital versus revenue, you can also write Infosys. Okay, that is also a revenue expenditure only. That is asset not getting created. Both all the three, Oriental Ceramics, PVR and Infosys. Others are all ITC. Two medical case laws which we have already seen. Medical case laws, CII, Confederation of Indian Pharmaceutical Association, and CAPSCAN. Both are seen. Others are all general. The medical circular challenge பண்ணாங்கன்னு சொன்னேன். அந்த circular freebies etc. Some quick clarifications. Expenditure on bonus issue is normally allowed, whereas rights issues is not allowed. These are not circulars or case laws, but clarifications. Rights issue is not allowed. Why? The law says rights issue means the overall capital base of the company increases. Bonus issue doesn't increase. General reserve becomes share capital. Bonus issue, your entry itself is general reserve account debit to share capital. So one form of capital becomes another form of capital. Though there is no overall change in the capital base. Whereas in right issue, there is an increase in the overall capital base. Generally, it is an assumption that the company will go in for an issue when they are expanding their business. So they will not allow it as deduction. Yeah, for the, if it is depending upon the type of expansion. Yes, you can take it as preliminary and claim it as 1/4. Interest on loan taken for payment of income tax, advance tax, anything, not allowed. Not allowed. Please understand. The interest takes the character of interest on payment of income tax itself. It is like 234 ABC. Income tax is not allowed. So interest on loan taken for income tax is also not allowed. Match பண்ணது கஷ்டம். Yeah. If you can match it, they are same. Whereas interest on loan taken for payment of dividend allowed. It is just cash flow assistance, so it is allowed. Friends, there are two types of penalty. Penalty in Ravate Pata don't disallow. Breach of contract allowed. Penalty for breach of contract allowed. Penalty for breach of law only disallowed. Sir, we both entered into an agreement that I need to supply him 100 units of raw material every month. Particular month I am unable to supply, so what I pay is compensation or penalty or anything. That is allowed. That is just a breach of contract, not breach of law. Only breach of law will be disallowed. So, breach of terms of contract, penalty for violation of law is only penalty for breach of terms of contract like supply, etc. on time or allowed as deduction. It's like compensation. Interest on delayed payment of GST or any other taxes, I told you, allowed. Interest is not treated as penalty. Penalty is for violation, hence disallowed. Interest is for late compliance, hence it will be allowed. However, interest under income tax law will not be allowed. And VRS compensation versus retrenchment compensation. VRS compensation, 5 equal installments, whereas retrenchment, closure of a business, immediately I am paying some employees, severance cost. These will be allowed immediately. There is no specific provision, hence it is allowed as deduction in the year of incurrence. Please read through once. Please read through once section 37 along with circulars case laws. Quick read through. That will not be allowed. Illegal means it will not be allowed.
No, sir. I mean specifically expenditure for reduction of capital.
Expenditure on reduction of capital, that is other than statutory payments, sir.
Yes, sir.
Allowed.
Which
General
section,
business
sir?
expenditure allowed.
Okay. Okay, sir.
In Neelavati case, the question is, we have also paid, okay, police, I accept that it is partaking the character of corruption. For Gundas, if we are paying, should it still be taking corruption? The answer is yes. They should not disturb the filming. Okay, that's why it is paid. So, normal securities are allowed as deduction. Bouncers are allowed as deduction. Yeah, nomenclature changes. The traffic signal that is erected. I think, I don't know whether it is qualifying as CSR expenditure. If it is coming under CSR expenditure and they have taken it as CSR expenditure, it will be disallowed. But this is a very old case law. The CSR munadi. Yeah, they have very specifically done for their employees. Yeah. I agree with you. You have a point. Safe crossing of employees. Road CSR expenditure, which will be generally allowed in section 30 to 35. I am contributing to IIT for scientific research. I can claim it as a CSR expenditure also, and also under section 35. When will an expenditure come under 37? Only if it is not mentioned in 30 to 36. Not allowed. The question was, in PVR, you said existing business, I did a feasibility study, it failed, I can claim it as an expenditure. If it is a new business, you cannot. You cannot. It should be a preliminary expenses of that particular business. It's like an expansion, you cannot. Any donation to Prime Minister's National Relief Fund or other donations will qualify both under CSR and under ATG. The first thing I used to tell before starting PGBP, which I want to again tell you is, forget office and be in classroom. Okay, because every time you read a provision, you will always think, office le the claim pannene. Okay, that is Onion. This is Ambi. You are all students now. Okay, so become a student back and don't confuse it with your practical world. Research expenditure, yeah, there should be an asset which is created out of it. If you are asking section 35, 35 has one particular statement. Even if there is a failure, you can still claim it as deduction. This is not, this speaker system and all are not research. They are just a different trial and error method of finding out whether. So research expenditure, even if there is a failure, you can claim it. But any other expenditure, which you thought you can try feasibility study, I want to start another manufacturing unit. I went and studied for a different manufacturer. I went and studied, I dropped that. It's like you have not started the business at all. Section 30 to 37 is expenditure expressly allowed by law. In our explanation, if you look at it, we divided our study like this. Asset-based deduction, that is what we studied. Deposit-based deduction, where assets itself can be claimed. Other deduction, general deduction. I also want to tell you very specifically, 38 illiya irukku. Not popular. That is where an asset is used for both personal and official purposes, a reasonable proportion should be considered as personal and okay. But when we speak colloquially, we always say 30 to 37, 30 to 37. Okay. Yeah. No, you don't relate those two things. It's not at all relatable. Okay. Now I am coming to the next part of our deduction explanation. Expenses expressly disallowed by law. 40, 40A, 43B. 40, 40A, 43B. Starting with section 40, the most interesting, TDS disallowance. Okay, default in two things: deduction of tax or remittance of tax. As a payer, our duty is two things, my dear friends. One, tax has to be deducted at source. Two, the deducted tax should be remitted into government account. If I don't do anything, there is a default. Deduction should be at the time of incurrence. Remittance before filing returns. Okay, repeating, deduction should be at the time of incurrence, that is before 31st March. Remittance should be at the time before filing of returns. Okay, if these conditions are satisfied, then it is allowed as deduction. Otherwise, 100% of the expenditure in the case of non-resident and 30% of the expenditure in the case of residents, payment to residents, will be disallowed. Before reading the theory, let me come up, and again, if you read the theory, you will get more clarity. Right. I failed to deduct. There is a disallowance. Later, I deduct. Law is telling us, however, in the year in which you are deducting or remitting, it will be allowed. If it has been disallowed because of a default, the year in which you are rectifying the default, you can claim the expenditure. The next wonderful thing that came into law. What is TDS? Let's go and a little understand deeper. That let us take, I am paying rent to Antonio. Is there a possibility I will not claim rent as an expenditure? I'm doing business. I'm paying rent to Antonio. Is there a possibility that I will not claim the rent as expenditure? If I don't claim the rent as expenditure, my profit will be high, my taxes will be high. So is there a possibility that I will not claim rent as an expenditure? No. Is there a possibility Antonio will not show the rent as income? The class okay. Everybody has said yes. There is a possibility. Antonio, chance. Okay. So there is a possibility that the receiver is not showing it as income, but there is all possibility that the payer will claim it as an expenditure. So I am putting it the liability on the source. Deduct the tax so that I am able to track the receiver. Okay. Why GST collection is so high and so correct? Because we will always be honest if we want to take the money from the other's pocket. Okay. TDS is also same principle. Anyhow, I have to pay rent to him. I will deduct tax. Why 10%, 40% also I will deduct tax. Anyhow, I have to pay. So there is a honesty from my end, and through which they are tracking the receiver. This is the intention, because you have to understand the intention to understand what I am saying now. The intention is tracking. Sir, I made a payment without deducting tax at source, friends. I made the payment without deducting tax at source. Later realizing I need to deduct. Now the receiver says, boss, whatever payment you have received, given me, I have taken it as income and paid the tax. This provision itself is a tracking mechanism, whether I am declaring it as income or not. So I have declared it as income, sir. So don't again, I have already paid tax. Why are you again deducting? The law has favorably been amended, where the receiver provides proof that he has considered it as income and paid the taxes for the same, then the default stands rectified. I need not again deduct it. Then the default, then claim it. Claim it when? In the year in which assessee provides the proof. I want to be slow, clear. Financial year 2021, I failed to deduct. He files the return on July 21 and provides me the proof. My filing is only September 21 or October 21. Can I claim in 2021? Means no. 2021 it is disallowed. 30% is disallowed in 2021. It is allowed in the year in which proof has been submitted, not in the year of incurrence. So, first I will disallow it. Next year, had I deducted, I can claim. Instead, he has submitted the proof, I can take it. Later, when we study TDS chapter, I will tell you, however, I am liable to pay interest. 201 interest. For non-deduction, I need to pay. Okay. Broadly, before going to the theory once more, two responsibilities are with me. Deduct tax, remit the deducted tax. Deduct tax in the year of incurrence. For all of us, before 31st March 22, deduct tax. Remit the tax on or before the due date of filing returns. If there is a default, 100% of expenditure if the payment is to a non-resident, 30% of expenditure if the payment to a resident is disallowed. However, the same is allowed in the year in which default is rectified. Addition made to the law, where the receiver submits proof that it has been considered as income. Proof means his income tax return, and taxes due are paid for that. Then, in the year in which he is giving the proof, the default stands rectified and deduction can be claimed. Act like 3 sections. All the 3 are saying the same thing. One for non-resident, where 100% disallowance. Another for residents, where 30% disallowance. Third is for payment of salaries to non-resident, where again 100%. But you can condense it and understand it in a simpler manner. (40) A subsection 1 non-resident was subclause 1, clause 1 non-resident, clause 1A. Any payment of interest, royalty, fees, and any other payments, okay, on which tax has to be deducted at source. Any payment on which tax has to be deducted at source under 192 or 194. Tax has to be deducted in the same financial year in which expenses are claimed on incurrence. Remitted on or before, or now it is 1 month prior to the due date of filing returns, because the auditor certificate is September 30th. Where there is a default, 100% of the expenditure will be disallowed. In the case of payment to non-resident, where it is payment to residents, 30% of expenditure will be disallowed. However, the same will be allowed in the year in which default is rectified. Okay, note. Where tax has been deducted at source, but the recipient provides proof of considering the same as income and paying taxes, then the disallowed amount will be allowed in the year in which the recipient furnishes his proof, that is a return of income. All part of 194. When I say 194, yeah. Where are you only a TDS? 192, 194, 195 is for non-resident. No, no, it is. I'll come to individual. Yes, we'll come to that. Question 26 will cover that. Question number 25. Question number 25. Company made the following payments to resident without deducting tax at source. What will be the tax consequence? Salary to employees, non-compete fees, directors' fees. Will your answer be different if the company has deducted in the month of, I should have changed it, April 22, July 22. I should have changed it, April 22, July 22. I don't know, I always missed to change it. April 22, July 22, please. April 22, July 22. While giving the final material, I'll change the date. Am I clear to you? Any doubts? Okay, right? Okay, so salary to employee is covered under section 192. Don't worry, I will do TDS. Those who cannot understand, don't worry. Non-compete fees in section 194J. Okay, and director sitting fees also section 194J is the TDS provision. Okay, don't worry about this. We will do the respective chapter. But as an understanding, what is the uniqueness of director sitting fees? What is the unique feature of director sitting fees? Not a problem. Not a problem. I know that we will study it. The only unique feature of director sitting fees is threshold limit is 0. Normally 194J threshold limit is 30,000. But even if I have given just 20,000 here, still there is a disallowance. You will study it in 194J. Don't worry. Okay, just as a additional aspect I told you. Okay, எனக்கு தெரியும் உங்களுக்கு தெரியும்னா அதுக்கு தான் சொன்னேன். Okay, right? This is also, if you cannot follow it, don't worry, leave it to me and I'll change the date when the final material is given to you. During the financial year, the following payments or expenditure were made incurred by Yuvan Raja, a resident individual whose turnover for the year ending 31/3/21 was 99 lakhs. Briefly discuss whether any disallowance provision is applicable. Interest 45,000 paid to a firm without deduction of tax at source. 3 lakhs as salary to a resident individual without deducting tax at source. Commission of 16,000 without deduction of tax at source. Read through, I will provide the answer. Don't worry. I know if you cannot recollect, don't worry. We'll do it in TDS provisions. No, it doesn't have any impact. Commission, the threshold is 15,000. Yeah. Okay. Okay. Now, all of us, I know this is tough to recollect, but I'm trying to help you out. For those who remember, fine. Section 194 is not applicable for individuals and HUF whose turnover does not exceed 1 crore during the financial year preceding. ஒரு individual or HUF for the financial year 21-22, whether he has to deduct tax or not, depends upon his turnover for the financial year 2021. We will study this in TDS more detailed. If in the financial year 2021, if the turnover does not exceed 1 crore, no TDS liability, no deduction liability under section 194. That is not for 192. Salaries you have to definitely deduct, whatever may be your case. Only for interest, commission, contract, professionals. Okay. So that's why the question starts with whose turnover for the year ended 31/3/21 was just 99 lakhs, which means he is not liable to deduct tax under 194 for the financial year 21-22. More about it when we do TDS also. Now on a general scale, I'm writing the theory. Tax deduction on business payments covered in section 194 is not applicable for individuals /HUF whose turnover does not exceed rupees 1 crore in the immediately preceding year. in the immediately preceding year. In law, my dear friends, please remember, there is a difference between previous year, preceding year. Previous year means the year in which we are writing the provisions, 21, 22. Any year before that, they will call it as preceding year. Right from the beginning of the law, we can see it. An individual will be considered as resident if he is in India for 60 days or more during the previous year and 365 days or more in the 4 years preceding the previous year. Preceding means that comes before the previous. So here, preceding year. So you have to see for 21, 22 whether it is applicable. You need to see the turnover of 2021. His point is just 3 lakhs, so there is no tax except at this point. Up to 5 lakhs, you need not deduct, but let's not go in deeper. Now, my interest is to make you, tedious understanding. Okay. This is the same for salary payable outside India also, 100% disallowance. Okay, payment, then the payment shall not be allowed if that tax is not deducted or remitted at source. Okay, right. This is the case which I told you is a literal construction case law. Literal construction case law. Palam Gas Services. Assessee is engaged in purchase and sale of cylinders. Transportation is made with 3 contractors. Freight payments were made which are tax deductible under 194C. However, assessee did not deduct tax specifying that tax is deductible only if the amount is payable and not when it is paid. Question is whether it is depending on the method of accounting. The Supreme Court said no. Whether it is obligation to deduct tax is mandatory and irrespective of the method of accounting followed by the assessee. Failure to deduct will attract disallowance. Okay, right. The next Next is a wonderful case law. I will refer to this case law in 4 or 5 places totally, including assessment and all. Appeal varaikum. I am paying a non-resident who does not have permanent establishment in India. Okay? The company is paying a non-resident who does not have PE in India. The amount that I am paying to him is not taxable in India. He does not have business connection in India. We'll see in non-resident what is this business connection and all, but he is not having business connection in India. So the amount I am paying to this non-resident, for that non-resident, it is not taxable in India. Should I deduct tax? Okay. Court held, no, you are not liable to deduct tax. Disallowance provision will not apply. When it is not an income to that person, when it is not an income to that non-resident, asking the assessee to deduct tax is unfair. If the assessee has not deducted tax, then, okay, we see it in many practical cases also. Exhibition conducted in Europe. One of the Indian company want to participate in that exhibition. The event manager has no business connection in India. He says, if you want a stall, pay me 10 lakhs. You don't deduct tax on me because I don't have anything in India to claim that tax. And the income for me does not accrue or arise from India because there is no business connection for me in India. I don't have a PE in India. So I paid without deducting tax at source. The law is now settled in Maruti Suzuki case. Payment made by the assessee to a non-resident who does not have any income assessable in India be disallowed on the grounds of non-deduction where no application has been made for nil or lower deduction, where the income is not chargeable to tax in India. Disallowance provision cannot be invoked. Okay, in the international taxation also there is a case law, Viscraft International. Okay, and here the same provision we will study. That is where I told you they are conducting exhibition across Europe and they will be having. So my dear friends, TDS default is one of the major provisions of 40. Apart from that, the normal provisions of equalization levy, which is also like TDS to a non-resident. Okay, I have a separate chapter in non-resident taxation equalization levy. It will be disallowed. Any income tax, here it is where I am saying income tax includes interest and penalty. That is why interest on 234 ABC is disallowed. Not because it is a penalty. Penalties are 271. This is just interest, but these are not allowed as deduction. Whereas interest on GST payment, delay payment, etc. are allowed. Tax on perquisite borne by the employer. Tax on perquisites of the employee borne by the employer are disallowed. These are all the disallowed things under 40, section 40. Okay, we will start with 40A tomorrow morning. Okay, we'll start with 40A, payment to relatives, 10,000 plus those payments, etc. By tomorrow, we should target to complete the provisions of this chapter. Okay, to a larger extent, it is possible. By tomorrow, if we complete the provisions, from next 2 days, we can work out all the comprehensive questions. Yes. Look at transport. It has nothing to do with principal agent. Transport. All the best, friends.